Alphabet Incorporated, famously known as Google, is currently the Superinvestors' favorite company in the world, including the likes of Bill Ackman, Seth Klarman, Pat Dorsey, and Michael Burry. We can easily see that by taking a quick look at the most owned stocks by Superinvestors on Dataroma, which is a website that tracks the portfolios of investors with over $100 million in qualifying assets through their financial filings. And as you know, Alphabet has two publicly traded stock tickers, Google and GOOG. And as you can see here, they both appear in the top 3 most owned stocks by Superinvestors with 33 and 26 total owners respectively. Some investors actually own both classes. So after accounting for that, we find that in total, 44 super investors own Google in their portfolio, comfortably beating Microsoft in second place with 31 total investors. So why do these super investors love Google so much? And is now a good time to buy the stock given its recent decline? In this video, we will answer this question by analyzing the Google stock, reviewing important financial metrics, comparing the stock's performance against competitors, and discussing potential risks associated with the company. By the end of the video, we will run the numbers through our valuation model, deciding on an acceptable buy price, and I'll also share with you my strategy and what I've been doing with Google in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia and just remind you that this is not financial or investment advice and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Founded in 1998, Google is a multinational technology conglomerate focusing on online advertising, search engine technology, cloud computing, as well as computer software and consumer electronics. In 2015, the company was reorganized as a subsidiary under a new parent company called Alphabet. Today, Google owns the 2 largest search engines in the world, Google, and as you probably guessed, YouTube, which together generate most of the company's revenue. It also owns Google Cloud, the 3rd largest cloud provider in the world, as well as the Android operating system and Google's hardware and consumer electronics segments. Additionally, Alphabet owns and invests in numerous other ventures, such as artificial intelligence with DeepMind, which is the developer of Gemini AI, healthcare and life sciences with Verily, self-driving technology with Waymo, and biotech with Caliso, as well as many, many more. Basically, Alphabet continuously acquires and invests in cutting-edge technologies and innovative projects across different industries aiming to drive innovation and shape the future of technology and human development. And so far, it has been very successful in doing so throughout its history. At the time of filming this video, Google is the 6th largest company in the world, with a market cap of $1.7 trillion, and currently trades at a price-to-earnings ratio of 25. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Google significantly beat the S&P, increasing 128% since March 2019, while the S&P increased 82%. However, year-to-date shows a different story, with Google dropping 2% while the S&P increased 8%. Now, when comparing its performance with its competitors, Microsoft, Apple, Amazon, and Meta, over the last 5 years, we'll notice that despite its great performance, Google actually lagged 3 out of its 4 competitors, with Apple, Microsoft, and Meta returning 267, 250, and 205% respectively, while Amazon was the only one that lagged Google, increasing 105% since 2019. Moving on to Google's financial statements, we see that revenues grew from $161.9 billion in 2019 to $307.4 billion in 2023. That's a CAGR, or a compound annual growth rate, of 16.6%. Similarly, we see that net income increased from $34.3 billion in 2019 to $73.8 billion, which is a CAGR of 20%. You'll notice that both metrics consistently increased year to year, except in 2022, where net income dropped before rebounding back in 2023. So overall, we see very strong top and bottom line growth for such a huge company, with both metrics roughly doubling in this 5-year period. As for the balance sheet, we see that the cash balance in 2019 was $119.7 billion and decreased to $110.9 billion in 2023, which is a CAGR of negative 1.8%. On the other hand, current assets, which also includes the cash balance, increased from $152.6 billion to $171.5 billion. That's a CAGR of 2.8%. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, increased from negative $103.7 billion in 2019 to negative $82.4 billion in 2023, which is a CAGR of 4.8%. Now, if you're new to the channel, you're probably wondering, how can net debt be negative? And what does it mean? Well, this basically means that Google's cash balance is currently higher than all the company's debt combined. And given that net debt is total debt minus cash and cash equivalents, the result is a negative number. To clarify this further, let's take this number here, the negative 82.4 billion. This value means that Google has enough cash on hand to pay off all the company's debt and still have this $82.4 billion left over, which is truly remarkable and demonstrates the outstanding balance sheet that Google has, which is actually one of the best, if not the best, balance sheet in the S&P 500 today. In terms of shares outstanding, Google's shares have decreased from 13.7 billion shares in 2014 to 12.7 billion shares today, meaning that Google has been buying back its own shares. We generally like to see declining shares as it signifies that our ownership stake in the company is getting bigger and that the company's profits are being distributed on less and less shareholders. Now, coming to Google's return on equity and return on invested capital, and just in case you don't remember or you're new to the channel, a high return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. Generally, we like to see a minimum of 10% for both metrics, however the thresholds could change slightly depending on the industry. As you can see here, other than a slight dip in 2017, Google's return on equity has always been over 14%, averaging 19.2% since 2014. Similarly, Google's return on invested capital has been consistently over 15% and surpassing our preferred threshold, averaging 19.7% over this 10-year period. In terms of operating and free cash flow margins, we see a similar story, with Google demonstrating its ability to sustain very healthy margins. Since 2014, operating margin has consistently exceeded 22%, averaging 25.9%, while free cash flow margin was generally in the high teens, low 20s, averaging 22.1% in this 10-year period. As for net debt to EBITDA, net debt to capital, and interest coverage, there's actually nothing to show. Google has virtually no debt. As we saw earlier, if they wanted to, the company can pay off all the debt owed with the cash on hand and still have over $82.4 billion of cash remaining. Now, before jumping into our valuation models, let's quickly discuss the reasons behind Google's recent decline and go over some relevant risks. So, the main reason behind the stock's underperformance is the company's failure to take advantage of the current AI revolution and effectively compete with Microsoft's ChatGPT. In fact, in a seemingly rushed effort to compete, Google fumbled on multiple occasions, from making errors while demoing their Bard AI chatbot to actually faking or misrepresenting parts of their new Gemini AI model release video to make it a little bit more impressive. Not only that, more recently, the company came under heavy criticism yet again after Gemini AI completely missed the mark and produced historically inaccurate images, including racially diverse Nazis, as well as Black and Native American women senators in the 1800s, which obviously did not happen. Basically, their AI algorithm was overcorrecting for the long-standing racial bias problems in AI. So to say that Google has completely dropped the ball on the AI revolution so far might be an understatement. Bill Ackman, an American billionaire hedge fund manager and super investor who's heavily invested in Google, making up 18.6% of his $10.4 billion portfolio, recently shared his opinion on this subject on the Lex Fridman podcast. So let's quickly see what he had to say, and we'll discuss it afterwards.
Really the sort of AI scare, I would call it. Microsoft comes out with ChatGPT. They do an amazing demonstration. People are like, this most incredible product. And Google, which had been working on AI even earlier, obviously Microsoft was behind in AI. It was really their ChatGPT deal that gave them a kind of a market presence. And then Google does this fairly disastrous demonstration of Bard. And the world says, oh my God, Google's fallen behind in AI. AI is the future. Stock gets crushed. Now, AI, of course, is a risk. If all of a sudden people start searching or asking questions of ChatGPT and don't start with the Google search bar, that's a risk to the company. And so our view, based on work we had done and talked to industry experts, is that Google, if anything, had by virtue of the investment they've made, the time, the energy that people put into it, we felt their AI capabilities were, if anything, potentially greater than Microsoft ChatGPT, and that the market had overreacted.
There are two main takeaways from this clip. First, Bill Ackman acknowledged the risks that AI platforms such as ChatGPT could impose on Google search, which is also the main driver of the negative sentiment around Google at the moment. Investors seem to believe that AI will completely replace Google search, already labeling Google as the new Kodak or IBM and discounting the entire operation of Google. However, he also believes that Google's AI capabilities are much stronger and more advanced than Microsoft, and that the only reason that Microsoft took the lead early is their acquisition of OpenAI and ChatGPT. Now, I strongly agree with that. Yes, Google definitely fumbled, but despite these really naive missteps, Google did actually build those products completely in-house, unlike Microsoft. And for example, the issue of the racially diverse image generation by Gemini, in a way, actually demonstrates Google's advanced AI capabilities that Bill Ackman mentioned. Developing an algorithm that recognizes and resolves the racial bias is not an easy task and has been in the works for years. On the other hand, adjusting the code for a more accurate historical representation after the fact is relatively much easier to do. Another risk that is important to recognize is the ongoing regulatory crackdowns and antitrust lawsuits against Google. In the past decade, the company has been fined by the EU on multiple occasions for anti-competitive practices, costing Google billions of dollars. In 2020, the US Department of Justice sued Google for monopolizing search engine and search advertising by paying companies like Apple to be their default browser. This case is pending closing arguments in May 2024. More recently, the US Department of Justice filed another lawsuit against Google, which will begin trial later this year for monopolizing digital advertising technologies. Now, Google is not the only company under scrutiny for antitrust violations. Other big tech like Meta, Amazon, Microsoft, and Apple are all being targeted by the US government as well as the EU. Although unlikely at this time, the main concern of these regulatory crackdowns is not really the financial part, but the possibility of a potential breakdown of the company, which could potentially end its near monopoly in search and other businesses. Now, remember the main question of the video, which is why do super investors love Google so much despite these risks? Bill Ackman eloquently addressed this question in the same interview that we discussed earlier. So rather than telling you what he said, let's hear it directly from him.
You know, the Google advertising search YouTube franchise is one of the most dominant franchises in the world. Very difficult to disrupt, extremely profitable. The world is moving from offline advertising to online advertising, and that trend, I think, continues. Why? Because you can actually see whether your ads work, and they really dominate that business. And they also have huge advantages by virtue. You think of all the data Google has, like the search data, all the various applications, email and otherwise, and the kind of the Google suite of products. It's an incredible data set. So they have more training data than pretty much any company in the world. They have incredible engineers. They have enormous financial resources. So that was kind of the bet. And we still think it's probably the cheapest of the big 7 companies in terms of the price you're paying for the business relative to its current earnings. It also is a business that has a lot of potential for efficiency. And then there's all kinds of what we call optionality in all the various businesses and investments they've made that are losing money. They've got a cloud business that's growing very rapidly, but they're investing basically 100% of the profits from that business in growth. So you're in that earnings number, you're not seeing any earnings from the cloud business. And, they're one of the top cloud players.
Okay, so we have 4 main takeaways from this clip. First, Google has one of the most dominant ecosystems in the world, if not the most dominant. This includes Google Search, YouTube, and Gmail, as well as Google Chrome and Maps, and all the other products and services offered by Google, which I personally think might be even more dominant than Apple's ecosystem. Second, with that ecosystem, Google has an abundance of data that can be used to train and develop artificial intelligence platforms. And in the world of AI and machine learning, data is considered the fuel or the foundation of AI. Third, Google still has a lot of potential for efficiency, whether through decreasing and optimizing their workforce, addressing their relatively high stock compensations, or adopting AI in their products and services. Adding that to the rapidly growing cloud business, which is just turning profitable, and all the other bets that we discussed earlier, really makes a very compelling investing thesis for Google. Finally, Ackman also mentioned something very interesting for potential investors. He said that out of the magnificent 7 companies, Google looks to be the cheapest. However, being the cheapest of a bunch of significantly expensive companies doesn't necessarily mean it's undervalued. Or does it? Stay tuned as we'll surely find out the answer from our valuation models. Jumping into our valuation models, we'll be reviewing 4 distinct models to get our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is the discounted free cash flow model, where we estimate Google's intrinsic value based on the present value of their estimated future cash flows. We can see here the free cash flow that Google generated over the last 10 years, growing at an average 24.2% per year. Based on analyst estimates, we use a 10% growth rate for future free cash flows. Using an 8% discount rate, we get the present value of all future free cash flow as well as the terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $188 per share, which is higher than Google's current stock price, indicating undervaluation. If you would like to get a copy of this valuation model and use it to value any company of your choice, you can now do so from the link in the description below. The second method is the multiples valuation model, where we obtain Google's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Google's current earnings per share to get our fair value, which is $230 per share. The third method is the dividend discount model, where we would estimate Google's fair value based on the present value of future dividend payments. However, Google does not pay a dividend at this time, so this model is not applicable, but it is available in the valuation models in case you're looking to value a dividend-paying stock. The last method that we will review today is the historical multiples valuation model, where we estimate Google's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PEs. As you can see here, the Google stock was trading at an average 25.6 PE during the last 5 years, 25.2 for the last 10 years, and 30.1 in the last 20 years. We calculate their average and multiply it by Google's current earnings per share to get a fair value of $156 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $192 per share. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a white moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With the 10% margin of safety, our acceptable buy price would be $172. For a 15% margin of safety, the acceptable buy price would be $163. And for a 20% margin of safety, it would be $153. So as you can see, Google does look to be undervalued, as Bill Ackman mentioned. Even with a 20% margin of safety, it looks to be a buy today. In terms of Wall Street's expectations for Google stock, they are forecasting it to trade at $162 per share in 12 months, which is lower than our estimated intrinsic value, but higher than the current price, implying over 19% potential upside from current levels. Now, there are 2 additional things that I would personally do to get my buy price for Google. First of all, I would increase the discount rate for the discounted free cash flow model to 9%, as I prefer to use higher discount rates for pure growth stocks like Google because I do not have the benefit of the dividend reinvestments. Doing so gives us a fair value of $155. And second, I would remove Amazon from the multiples valuation model as it is currently trading at a much higher PE ratio, so it's technically causing the fair value to skew upwards, which we generally want to avoid. Removing Amazon from our model decreases the fair value from $230 to $189, which is still higher than the current price. So going back to our stock valuation, we can see that these 2 changes reduce the intrinsic value from $192 to $167, which is a pretty significant decrease, but still higher than the current price. With a 10% margin of safety, our acceptable buy price would be $150. So with a 10% margin of safety, the stock would be a buy today. For a 15% margin of safety, the acceptable buy price would be $142. And with a 20% margin of safety, it would be $133 per share, which is just under the current stock price. So as you can see, despite the conservative changes that we made, Google still looks to be undervalued and an intriguing buy today. I do agree with Bill Ackman, Google is the best valued Magnificent 7 company today, and it is also my largest individual stock in my personal portfolio. I also believe that the AI risks that we discussed earlier are short term, and that eventually, once they get things going, people will forget about the recent fumbles exactly like they did with Meta and Netflix since 2022. Again, if you would like to make different assumptions or play around with the numbers, you can now get a copy of the exact valuation models used in this video from the link in the description below. If you enjoyed this analysis, please make sure to check our other stock analysis videos and let me know in the comments below your thoughts about the stock and whether you're making any moves with Google in your own portfolios. With that being said, don't forget to like and subscribe, and I'll see you in the next video.